Happy afternoon, everyone, and a warm welcome to all of you joining us for today's webinar. It's about demystifying compensation plans, design, communicate, and retain effectively. My name, Arun Kumar. I'm partner consulting. I'm delighted to be representing Anveshan Business Solutions as your host for this session. Just a brief about our approaches generally at Anveshan. Our focus has always been on enabling founders, CXOs, business leaders to make informed decisions in areas that directly impact growth, governance, and long-term sustainability in their businesses. And one such critical area we all agree is talent, retention of talent. So today's discussion will shed light on how organizations can design a fair, motivating, and sustainable compensation structures that help attract as well as retain the talent, right talent. So on this matter, of course, my colleagues, I have CA Vijay Simha and CA Divya Jain will be taking us through the entire presentation, which has been designed and developed by them. And let us get into that. Before that, we just want to brief about Anveshan little more. Yeah, next slide. Yeah, about Anveshan, it's a boutique consulting firm and it's a consulting arm of chartered accountant firm called Suresh & Co. We provide financial and regulatory solutions. We believe challenges may come from anywhere, but this is how we've been practicing. Solutions should come from Anveshan or through Anveshan. This is how we operate. Next slide. These are the some of the areas that we practice regularly. That is corporate structuring and restructuring, tax and regulatory advisory, fundraising and M&A support, due diligence services, valuation services, advisory for startups. We also advise on personal front with respect to estate planning and business succession planning. Of course, today's topic being long-term compensation plans. This is one of our practice areas. Of course, apart from that, financial modeling and arbitration support services is what we provide. And in the recent past, we have also put efforts in creating something called self-assessment on readiness in businesses. This can be in various areas. One, for example, it can be MIS, that is Management Information Systems, that flow or that has to flow to the promoters on a regular basis. Or it can be on compensation plans, which we call it as my pace, or due diligence readiness, or if you're going through or planning for going through a fundraise or M&A, how ready you are, how ready is your business, or if some businesses are looking at entering into India from overseas. We have a assessment called MyGate. So these are some of the assessments that we have created in the recent past. I would request you all to look into and then explore and give your feedback on this self-assessment. There are rating system once you complete the questionnaire, and it also gives you, based on the rating, how much ready you are in terms of your these aspects with respect to your businesses. So I would insist, please check it out and give your feedback. Yeah, apart from that, we have team from HISA. Of course, Vijay Simha will be introducing them during the course. There, they have developed a tool and it's a platform which can be used for compensation plans. I'll not talk much about it because they are the best to talk about. So having said this, I'll hand over the mic to my colleagues Vijay Simha and Divya to take us through the presentation. Over to you.
Thank you, Arun sir. So good afternoon, everyone. So as Arun sir mentioned to you for the last 2 minutes, we are from we are a team from Anvation. That's the consulting arm of Suresh and Co. So today here we are to present you on demystifying equity settled and equity settled compensation plans. So before we get into the complete presentation on what we are going to present, let's just see what at the end of this presentation, at the end of the next 1 hour, what are we going to achieve? So one thing is, initially these compensation plans were not well heard of. So there were traditional bonus plans that were in place. How did these bonus plans evolve? Their outlook evolved and came to modern methods. And what are the current modern methods available in terms of compensation to employees? And in those modern methods, are there any alternatives that are available that are much easier comparatively for the with respect to implementation? And when it comes to choosing a plan, there is a bigger part called as implementation. And in that part, we will take you through what are those issues that come up in each step and what are the best practices in the industry or the solutions. And then we have HISA, an ESOP management platform by Rule Zero. So they will be giving their pitch for around 15 minutes during the presentation. And of course, after all of this is covered, we will be taking you through the Q&A sessions. So any questions or any doubts that arise during the session, we request you to post it on the Q&A channel or in the comment section. Once the session, the technical part is complete, we will be giving you the access to mic and we will be addressing each of them separately. So without further delay, we will get into the presentation. So first part is evolution of incentive approaches. So now it always reminds me of a small story when it comes to incentives. So I have always seen my uncle who was working for a big company, an MNC, and like everybody of us, like everyone else, he used to have complaints about his work. But at the same time, I was as a kid always wondering, okay, if that's so, what to say, problematic, why don't you just leave that? But he used to always tell me, no, it's not that. There is something better that I am looking for, which you do not see today. And then after a period of 3 to 4 years is when I got to know that he was going to receive a bigger or a better incentive. And he was ready to go through all of that for the next 4 years for that D-Day. And what was that is what we are going to learn in the next few slides. So now, how did these incentive models evolve? So, as a part of the regulatory compliance, the Bonus Act was introduced, wherein the companies or the employers were supposed to give bonus as a mandatory compliance thing to all their employees. And the regulations also provided the way of calculating such bonuses. And then once these bonuses became mandatory, there was a small shift from that being a mandatory thing to something that is linked to a performance. Now, even after doing all those performance related bonuses, it was always observed that usually whenever we observe a bonus plan, it will normally be quarterly, half yearly, or maximum annually. So it will always make an employee think about short term goals because he will say, okay, I'm going to receive so much bonus at the end of the year. So let's make sure I do my best to until that date. So the goals were short term, and none of them thought about, okay, what will happen to me if I stay in the same organization for the next 5 years? So that shift from a transactional mindset. What is a transactional mindset? Okay, I get my salary month on month to transformational mindset, which is like if I be part of this entity for the next 5 years, I can transform this company as well as my personal life. So that's where the shift or the evolution happened in terms of rewards. So now just to put it in a simple way, I would say salary was a transactional thing wherein you do work and you get it at the end of every month. No much, motivation required. It's just the routine job. Then next came the performance linked bonuses. That's motivational, where somebody is looking forward to a number at the end of each year. So that's the transactional to motivational. And then from motivational, I want people who think like entrepreneurs. I want people who are ready to stay in this entity to build a unicorn. So that's where the ownership or the transformational model came in. So when I say the topic itself says design, communicate, and retain effectively, it it comes through such transformational mindsets wherein I am going to design a plan that's giving you a transformational growth, and then I'm going to communicate it in such a way that you are motivated to achieve it, and in turn that is helping me to retain all my employees. So going forward, the question that often arises in all entities is that does all the top performance think short term? So if my performers are thinking short term, how do I deal with this problem? What's the alternative? So just to brief it again, now bonus as a compliance shifted from compliance to performance based. Now performance based shift to retention. So it's a way of retention. Now retention has moved to ownership. So the shift from compliance to ownership was something that none of them thought about probably 20 years ago. Now, what are those modern methods? So I was talking about being a transformational or a ownership based reward model. So what is that? That brings us to the concept of compensation plans. So what are compensation plans? I would say those are methodologies built for a company's success story. Now, just to put it in simple words that everyone understands, that it's something like the shares or options to exercise those shares are normally given to employees, and they will have to stay for a period of 3 to 4 years to be eligible to get those shares. And at the end of that year, they will be getting the value of exercising those shares at a discounted price. So that's the normal understanding. Is it just giving them shares at the end of 3 years? Or is it just retaining them for the 3 years? What else is it going to, is it achieving by this? The next, so we always use the word skin in the game. So the moment a person has skin in the game, he looks at things in a different perspective. He thinks each work he does today is going to contribute for that exponential growth that's coming towards him in the next 4 years. So that skin in the game makes the employer's job easy because the employees are self-motivated because they're working for their own shares. And then it's building a culture called co-creator. So nobody feels that I'm an employee and somebody else is an employer, I'm working under him. They all feel that we're all working towards one goal, and that one goal is to take company to, let's say, 1,000 crore valuation. So what is this kind of employment or compensation models achieving? One thing is it's aligning the employees to organizational objectives. So when I say these objectives, it's not objectives that I need to achieve a particular revenue or a EBITDA at the end of the year. It's that I want to go to IPO in the next 4 years. And then it ensures long-term association and reduces attrition. Goes without saying, the whole purpose of putting these things in place is retention. Ensures improved performance, which was already told, and converts employment into shared success. That is shared success because it brings in a sense of entrepreneurship into the minds of the employees, and also helps in creation of wealth to all of them. Now, just to understand, now we all talk about, I'm giving compensation plans, I'm going to issue ESOPs to my employees. But is it going to directly benefit me today? This small illustration here shows how it does. So now the traditional method is that bonus route, wherein let's say I have a profit of around 100 crores before salaries, and I have to give a particular senior manager who is like the superhero in my company 10 crores, that is including of a bonus of around 2 crores. Now the profit post salary comes to 90 crores. Considering an EBITDA or a profit multiple of 10 running in that industry, my enterprise valuation is 900 crores. So this, whatever salary that is directly hitting my P&L has a higher direct impact on my valuation. Now let's look at the ESOP or the equity settled route. Now the same 100 crores profit, I am paying the person 8 crores in salary. The balance 2 crores of bonus, I am giving it in terms of an ESOP plan. Today, I am not going to make any cash payments to him. He has to wait for 4 years to get those shares. One part is I'm saving 2 crores immediate cash. The second part is those shares that are worth 2 crores today at the end of 4 years can be 10x or 5x. So the employee's growth is not just 2 crores, he can expect much more than that. Now, if we see how the profit works out, so there is a saving of around 2 crores. 10 times that 2 crores is a direct increase in my valuation. So this is one aspect that we need to always consider when thinking of going to a traditional route or the modern route. Okay, so now we all know there are modern routes of compensation plans. The first thing is who can get the benefit out of it? Look, can everybody get the benefit? Definitely not. Within an organization, it will be the senior management and employees. Those are the human assets, most important human assets. In addition to those, there are few compensation plans that can be designed to give for external advisors or consultants, and also for vendors who have been with us in our past success journey, and we would want to reward them. Coming to the types of settlement plans, one is the equity settled plans, wherein the option to exercise equities or direct stock are being issued to employees or senior management, and then they typically vest over a 3 to 4 year period, so which requires them to stay for a particular period and also achieve few performance conditions. And upon vesting, they might have to pay a small amount of exercise price and then buy those shares from the company. So this directly gives them the shareholding in the company and also that upswing in the value. Now, what are the various uh, types of equity settled plans available? One is ESOPs, which all of us are mostly aware of. Then stock purchase plans, sweat equities, and restricted stock units. Let me just take a few minutes to give a brief on all of this in a very short way. So employee stock option plans are those that it gives an option to the employee to buy those shares at the end of the vesting period. It's not an obligation. At the end of the vesting period, only if the market value is much higher than the exercise price, and the employee feels that if he is going to exercise this, he is going to be in a benefiting position, then he can exercise it. That's the ESOP. Then ESPP is like the employees can purchase the shares mostly at a discount. Now, it is not like an option granted. They will get the stock at first itself. And then the sweat equity. In terms of sweat equity, it does not differ much from the other two plans that we spoke about, but it will normally be given to promoters or senior ones, not like the middle level or the lower level employees. And it will be like a compensation for a very long period of association or a know-how or an intellectual property that they brought into the company in the initial stages. So we always say he has paid us not with money, with his sweat. So I am going to compensate him for the sweat he has given me. And then the restricted stock units is like employees are again promised, not optional, unlike ESOPs, but they are promised that they will be given some shares and that are granted and vested over a period. And then in this case, unlike ESOPs, we do not have an exercise price that has to be paid. The ownership automatically comes to the employees. So now this gives us a brief about the plans that are available under the equity settled option. But can we say equity settled are the only right choice to compensate our employees? Which is not true, because there are some issues of, I want to take care of my cap table. There is a dilution that's going to come in the moment there is an exercise. And also there is an issue of, I have some consultants or advisors that I spoke about in the last slide. I want to compensate. So these plans actually do not cover them. So then what is the alternative that's available? So now thinking of the alternative that's available, we get into, so before I introduce those alternatives, I will tell you how are the layers of a particular salary can be designed in a particular entity. First is the base compensation layer, wherein I'm going to pay a particular person for his talent in terms of the market, whatever the market pays him, I want to pay him on a monthly basis. That's the transactional salary that I spoke about. And then the performance bonus, wherein the performance can be like a percentage of salary, or I say if you reach so and so amount of revenue, or if you do so and so KPIs or key performance indicators, I will be paying you a certain amount of salary. It need not always be an annual pay. It can also be like if somebody stays with me for a period of 3 years, I'm going to pay him a loyalty bonus of some amount, something like that. So that's the performance based bonus layer. And then if there is somebody who has to be rewarded much more than just bonus, then we come to the equity layer, wherein that what we spoke about a minute ago about the equity settled plans, where we ask the person to stay for 3 to 4 years, and then he vests all those options, and then later on he's allowed to exercise those options. So after this, there is another layer called cash settled layer. It's something like an equity ownership layer, but cash settled, that can be given to advisors, even for employees, but also accommodates advisors, which we will be covering in the further slides. Then, in terms of giving these or having these settlement plans in place, it need not always be a straightforward, okay, somebody stays with me for 3 years and he's going to vest all those options equally. It can also be tiered. So when I say tiered, let's just assume a case where I want to issue 100 options to a particular employee. I can have a vesting period that with a 1 year cliff. So when I say 3 year vesting with 1 year cliff, I say 50% of those options are going to vest in the first year, and the balance 50% is going to vest in the next 2 years. So in this, if we observe the first 50%, that the maximum amount of the options are being vested in the first year, wherein it's a cliff. When I say cliff, it's the highest vesting happens in that year. That is one. And then condition combinations, when I say we can design ESOPs or other cash and equity settled plans to include both service conditions and performance conditions, which my colleague will be covering in the further slides in detail. So how did these cash settled plans actually come into place? So these have become a very good or a powerful alternative because a lot of employees are actually looking for liquidation, or they want those cash payouts to be immediate, because there are few inherent limitations with an equity settled plan. As in, if somebody has to exercise their plan today, they might have to wait for the next funding round or an IPO to happen until they can exit. But with these cash settled plans, they're going to get the value of those shares on the current date, and they can, they have money in hand. So it's always believed that money in hand is always preferred more than money that can come to me, next 4 or 5 years later. So it is one way, it is, helping employees with direct cash payouts. The other two major advantages for the employer or the companies that are issuing this is that one is that it avoids equity compliance. First thing is it comes with zero dilution. So those promoters who are not willing to give up their equity, or these family offices who do not want other than family members to be part of their cap table, can easily work out these models with zero dilution. And it also avoids equity compliance, because we are all aware of the lot of regulatory compliance that comes up with issuance of any equity shares. So those can also be avoided. So this covers why cash settled plans are better than equity settled plans. Let's also discuss the two cash settled plans that are popular, that are mostly used in the industry. One is the phantom stocks, wherein the employee, whoever is given the phantom stock, again, even here there is a vesting period, unlike everything like ESOPs, but he will be getting the full value of the stock as on the exercise date or as on the cash payout date. If let's say my stock values 500 per share at that date, he will be getting the full value to his account. In the same way, we have stock appreciation rights, which are also another cash settled instruments, or we also famously call it as SARS, wherein the employees again have to stay for a particular period. They vest it over a period of time, but they are going to get the appreciation of the share value. So the employee is eligible only for the appreciation of the share value from the grant date till the payout or the exercise date. So that's the main difference between both of this, but it is going to achieve the same thing, that it's going to provide immediate liquidity. So the next thing is, uh, now how do I choose if I have to go for a cash settled plan or an equity settled plan? There is no ready answer, because I always like to say this golden statement that all plans or all schemes are not easily applicable to everyone. So it has to be customized, it has to be handcrafted with specific needs of the company. We have to keep in mind the specific needs of the company, and only then can we, there is no right answer called, okay, which is the perfect plan that I can just plug and play. So at the time of doing this, we also have to think what is the objective of the entity. Is the entity looking for dilution today, or is it okay that it wants to make some amount of cash payout rather than giving dilution? That normally comes with family-owned businesses. The second one is, how are my employees looking at this? Are they okay for an equity, or are they okay for a liquidity? So that also adds a lot of thought when we have to decide the type of plan that we want to do. That being said, we just have a poly that's coming up now, that will be launched by our team. Just take a few seconds to answer that, and then we can move forward. Sam, can I move forward? Okay, so I hope everyone answered the poly. So now we are entering into the heart of this webinar, or the technical part, where we are getting into the implementation part of how exactly a compensation plan that is, planned to implement can be done. So how we are going to do this is that we are going step by step. We are going to identify all the steps that are required to reach to the final exit. So I would say this process starts from the thought of giving a compensation plan till an employee exits with the money or with the reward that he has to get. So in each stage, we are going to addressing those issues or considerations that normally come up with the best practices in the industry or the solutions. And most of this have come from, or all of this have come from our past experiences. And in cases where the concerns have been observed by us, the company's side and the employee side, how things have worked out. And based on that, we have put all of this. So before we get into the detailed steps, so the whole compensation plan have a normal cycle. So that is grant, vest, and exercise. When I say this, when I say grant, it means that we are going to have a plan in place. We are going to grant, whether it is equity settled or cash settled, it's being granted. They have to stay for a particular period of time. That's the vesting period. That's common for both of them. And then comes the exercise, that is with respect to equity settled, where the employees pay a certain amount of money and then exercise or get those equities into their account. And the settlement or cash settled plans, where the employees are being paid money or cash payouts from the company's side, where they get money or monetary consideration to their account. But when I say this here, it seems to be very simple. I can just say, okay, grant hota hai, and then vesting hota hai, and then exercise. But when it actually happens, when I have to say I have granted so many options to my employees, within that stage itself, I need to follow 6 other processes to come to that stage. So that is what we are going. So in these three main life cycle processes, there are much more processes inbuilt. The first one and the most important one is the awareness about compensation plan. As I already started with with this webinar, saying that a lot of people are not aware of existence of these compensation plans. So they are still resorting to the traditional approaches of bonuses, or giving performance based cash payouts for their employees. So first thing is, a lot of companies do not know that they can also issue compensation plans. It was also, when I found out that a lot of people thought it's only listed entities that can do these compensation plans. So that's not a and that's not true. Any company can do compensation, give equity settled or cash settled plans. And then at the same time, even though there is a plan in place, the management team or the people who are managing it in the top are not well aware of the detailed terms and the nitty-gritties that have to follow these compensation plans, and at what stage what has to be done. And the whole management is not that easy, we agree, but awareness also is required. And then the next thing is, these compensation plans are given normally for a particular employee who is going to stay for the next years for his past, which is okay. At the same time, we also strongly recommend that it has to be linked to business strategy or the growth of the company. So it has to go hand in hand. When I am saying that I'm going to reward a particular person for the upswing in the price or whatever that is going to come, I should also make sure the compensation plan is handcrafted so that the person who is about to achieve that is also aware of that. And then and there is a lot of misconception about the pool creation also. Some people say that if they have to create a pool, it has to be only once, and then if they want to increase the pool, they cannot do it. So I do not have enough pool to accommodate my employees. So these things are normally things that are coming from a company's perspective. So the solution that we have always told, or we always suggest people, is you always take help of your professionals, because they are the ones who come very handy to you. You have a plan and you're not able to figure out things, please run to a professional, and he will make you understand, and he'll help you, handhold you throughout the process, and build a roadmap for the plan and communication and governance. So this is another most important thing, because having a roadmap, I will say, that is like what has to be done when. Knowing that what has to be done when is more important. So today is day one. I'm going to grant my ESOPs to my employees. What has to be done today? And there is day 365 where it's year end. What am I going to do that day? And there is day 1000 where I've crossed 3 to 4 years. What has to be done that day? So these roadmaps, again, professionals will come, very helpful to you in creating all of this. That apart, we also have the employees who are the heart of these compensation plans, because without them agreeing or being supportive with this, none of this can be actually achieved. But what happens in an employee's mind is that it's always told, poor awareness kills motivation. So when there's no awareness about how big something can take you, then there is no motivation to work towards it. So the first thing is, the employees again are not very much aware of about what an ESOP or an incentive plan always is, and they always see it like a paper benefit. They are saying, the normal misconception is that, okay, we have been given all of these plans just to avoid the cash payment, immediate cash payments, and to postpone it for another date. It's just a paper. So we have to probably make them understand that this is not just a paper. This paper is worth more than what you can imagine. And then they're not again aware of what a vesting condition is, how much tax they have to pay at the end. And there is this again, that they don't need to pay any tax because I have already waited for 3 years. Again, why should I have to pay tax? All of these things come up when we normally discuss with employees. So again, how do we tackle these issues? So one thing is conducting of employee orientation sessions, which we have done a lot. Like, we have addressed a lot of employees and made them understand what actually an ESOP means, what they are going to get from a particular plan. And then, we should change their employee mindset to an ownership or an entrepreneurship mindset. And then how long-term wealth creation is the game. And then employees generally come up with a lot of questions. We should be able to, however small or simple that question is, we should be, patient enough to answer all of them. And then create dashboards for those employees to see how well they have performed in the last 1 year. So if the employee has to see how many shares have or options have vested into my account, they definitely need a platform or a dashboard that shows them, okay, this is what is mine. Let's say 100 done, 50 more to go. So then he'll be like, okay, I'm almost there. So those small, perks is something that keeps them motivated. So now that we are all aware, now even the company is aware, the employees are aware, everybody has accepted. And then now the company is saying that, okay, I have to put a plan in place. Next question always arises, that how do I identify whom to give it? I have an organization that is, let's just say 100 people, and all 100 people are equally important to me. I cannot run an organization without those 100 people, which is really true. But we cannot give an ESOP for all the 100 people, and there is no point. So again, there are three ways that I have broken into. So one thing is that there is an uncertainty on whether ESOP should go to all employees or key managers or only to critical contributors. So there is no right answer to this, but always I would say you have to divide the team or the total personnel in your organization to different levels. One is the functional roles or the executional roles. that actually does the execution. Then comes the managerial role, which monitors the execution level. And then comes the strategic or the senior management role, who are responsible for running the business or taking strategic decisions. Now, the weightage you give for a strategic level versus a managerial level will always be different. At the same time, you also limit your inclusion to people who actually influence the growth. Now, I cannot say all 100 people are required for me to go from today to the next 1,000 crore valuation, because definitely each employee is valuable. At the same time, there are employees who can be, replaceable. I would always prefer to retain a person who is at the strategic or a managerial level versus a person who's at an executional level. The second issue normally is that struggle to identify which roles genuinely are driving long-term enterprise performance. Now, okay, I say there is a managerial person, there is a senior person. Now, is this person actually contributing towards the long-term goal? That's another question to answer. Now, again, what we say is you create a multi-year performance trend, wherein for the last 5 to 6 years, how has this person performed? How has his team performed? Not just 1 or 2 years. See for the past how he has done, and create something like a scorecard wherein different parameters of a particular team or an employee is seen. Example, has he achieved the revenue growth, was whatever was budgeted, whatever was actually achieved? How has the margins improved? How has the person improved personally from where he came from? So these things will give us the answer. Okay, if this person is someone who is actually creating value, or is he someone who is just going with the flow? And then if ESOPs are seen as reserved for a few, it can create dissatisfaction among the others. A very, very vital aspect, because the moment the employees are aware that there is something called as ESOPs and only 10 people out of 100 are getting, this is going to create a lot of differences of opinion. Now, all we can do is communicate to those people that what it takes for them to be here, what it takes for them to get an ESOP, and at the same time how they have to perform for the next 1 or 2 years, or whatever their roadmap is to achieve wherever they are today. So this way we have identified the levels and then identified those people who are very important, and then let's say we have identified 10 people that they are going to get my ESOPs or phantoms. Before we get into the next topic, there is also a small regulatory aspect that covers what can be given to whom. So the company's shared capital and debenture rules 2014 says, as per Rule 12, it says that ESOPs can be given to employees of a particular company. It can also be given to employees of the holding company and for employees of the subsidiary company. If it's an Indian subsidiary, it can give to its holding outside India, or a holding entity outside India can give it to its subsidiaries in India. There is no restriction. And even directors can be given. Directors, I mean the executive directors, and independent directors definitely are not allowed, because as per the Companies Act, they're not allowed to hold any shares in the company. And at the same time, there is another addition that any group of promoters or anyone who is holding more than 10% of the equity cannot be given ESOP. So if somebody is holding already more than 10% in my company, they are much better than getting a 1% or 2% ESOP. And at the same time, there are few exclusions given for startups that will again be covered in the future PPT part. Now let's just take an example. Now, if we see all these examples, so now let's see this. Manufacturing company grants ESOPs only to plant heads and finance controllers that are directly linked to cost control and production efficiency. So manufacturing entity being something that the cost savings are the major ones. So the plant heads are the only ones that are running the company. Unlike a service sector, manufacturing entity has to run based on the production. So the plant heads are chosen eligible, perfect. And at the same time, the finance controller, because who is like the person who is at the top consolidating all of these at once. So that person, so this is a good example for an equity settled plan. And then the next one says the tech startup extends phantoms to all employees with more than 2 years service, builds ownership culture without dilution. So in this case, normally startup being a startup, we have a lot of funds of funding rounds that are going on. So we can choose those employees that have been with us from the start and give them some sort of payout or liquidation at the time of fundraise. And then there is another one where a group structure wherein holding company is giving its ESOPs to subsidiaries managers. Now, normally what we have observed or what normally happens is that the holding entities will be those bigger entities that will be listed or have much stronger financial strength. So when an employee gets the ESOPs or shares of those entities, he will be much more motivated than getting the shares of a subsidiary that will relatively be smaller than the holding entity. So now in each of these cases, if you see, the plans are very different. That's what I told. There is no one plan that suits everyone. So in each of these examples, we see people are customizing it however they need. So next one is so we have identified whoever are our employees. Let's just say I need 10 employees. I have identified them. Now I need to issue ESOPs or SARs to them. Before doing that, I need to create a pool. So what is a pool? So it represents the number of options or the stocks that are set aside as part of my total capital in the company. And none of this will be granted immediately because that will follow a particular rule called vesting period, exercise period, and then only it will be granted. But you are keeping it aside, saying that I am going to keep so many shares aside for my employees. And it will normally be told as a percentage of my paid up capital. So I say 5% of my paid up capital is my ESOP pool. So if I have a 1 lakh shares, I'll say around 5% of that is being kept as ESOP pool. So the next thing is there are few considerations or concerns that arise. Now, normally, is there a limit prescribed by the regulators telling this is the pool size that has to be given in a company? The answer is no. There is no specific percentage limit that is prescribed. But often promoters or business owners are confused on how much a pool has to be because they are of the opinion that these cannot be increased once set. So I want to make sure that next 20 years, whoever comes in, I want to keep a pool. So the first part is that we always suggest them to have a pool that is around 5 to 15% of their paid up capital. 15 again is a very higher number, but still that has happened in few cases. And the second thing is not able to increase my pool in future is a wrong conception. It can definitely be done. And there are few approvals and regulations that we have to follow, and that can be done very easily. A scheme has to specify. Now, whenever we put a scheme, we'll go and see what a scheme is in further slides. But the scheme has to clearly verify who are those eligible employees and what is the pool that I have kept aside for this particular scheme. So once the pool creation is happened, there is another bigger fish that is waiting, that is designing the allocation framework. So what do I mean by designing the allocation framework? So let's just take an example. So I have the pool size of let's say 5,000 shares. Now I want to know 5,000 shares between 10 employees, how much should each of them get? And how do I design this? So first, before that, let's differentiate the employees. Normally, it is on three basic level. One is level based, that is seniority or manager level, strategic level, execution level. Then is the performance based. Performance based is how good that employee has performed in the last 2 years or how good has he grown in this entity. And the third and the most important one is the contribution based. So when I say contribution based, it will normally be for the past contribution, the service they have given for last 10 years, 20 years for this organization. So after that, we design or normally we help designing criteria to design these payouts or how much options has to be granted. So one particular case was that we just told a percentage of the valuation. Let's say 100 crore is my valuation. I say 5% of that 100 crore being 5 crores is something that I want to distribute towards these 10 people who have been with me for the last 10 years. That's one way. And there is another one where we ask the management to set parameters such as tenure of stay, performance, criticality of their role, their leadership impact, and how potential they are for the future. And all of this are given marks by the management. Let's say out of 10, we ask them to rate each person on all of these aspects. And all of these marks are then taken as weights. Now there will be more weight given to people who are more potential for the future and how critical their role is. So the weightage, then the weighted average of those are calculated to arrive at the percentages. And those percentage, let's say out of the total, this particular employee got was 10%. Now, out of the 5,000 shares that are kept aside, I say 10,000, 10% of this 5,000 has to be allocated to this person. So this is how, this is just a methodology. There can be much more better ways of calculating or allocating the ESOPs or phantoms. Now I'm just showing you an illustration. If you all observe here, this table, here we have 5 people, and each of them are, one is a head of plant one is head of plant two, there is head of sales, and everybody is important. And we also have their past days of service, how long they have stayed with us. Now I have put three major, um, you know, parameters. One is contribution, past contribution, how critical their job is, and how does the management score them. So now there are two promoters, let's say Mr. X and Mr. Y, and both of them are giving their marks, whatever their perception of this person is. Then we have taken a weighted total of all of this, and the total of those weights will be taken as a percentage. And assuming my number of shares available is a particular number, let's say 1 lakh, out of that 7% will go to that person. Now, when I say 7% goes to that person, now in this case, it's around 3,900 shares. Now, these 3,900 shares, let's assume 1,000 is the price per share. So what is the value that's accruing to him? It's around 39 lakhs. So that is one. So I have arrived at, okay, I need to give him 39 lakhs. Then I keep a second level cap. I say, I want to also cap this compensation to be 25% of his CTC. Now, if we have a look at this, his CTC is 10 lakhs. So I am saying 25% of that is to be capped. So 39 lakhs or 25% of 10 lakhs, whichever is lower. So it will be 2.5 lakhs. So this is just a mechanism which was done in one of those cases. So likewise, we have done for all the other 4 employees. So this gives an idea about how an allocation works. So now, before we get into the next topic, Divya, my colleague Divya, will be taking up the next topic going forward. I request for the poll to be issued.
Thank you, Vijay Sinha, for taking us to this presentation till now. Now, coming up next to the design of the scheme. So we have seen how allocation is done, who all are needs to be eligible for the plan, how to pick them and all. Now, for designing stage, so there are different factors that needs to be kept in mind when we are actually designing the scheme. So what are the aspects? So there are three stages which my colleague has briefed before, which is like grant, rest, and exercise. So in each of the stages, there are different considerations that needs to be kept in mind, and based on that the clauses need to be incorporated in the scheme. So the basic goal should be the scheme should be simple to understand, and it should be aligned to the value creation. So how do we align it to the value creation? So the basic thing is, whenever we take up the implementation plan, what we will do is we will have a meeting with the promoter, because we need to know what is the intent of the promoter, what is that which promoter wants to reward to the employees as a benefit, whether he wants to give employees the stakeholdership or he want to compensate them in cash. So based on this, the first aspect is the type of schema, which is like whether it is equity settled or cash settled. And we have briefed before, like there is no proper fit plan for any entity. It can be customized, and it can be taken up on the basis of the requirement of the entity. Coming up with the second aspect, which is eligibility criteria, which Vijay Simha has actually explained it before. Like what all are the factors that needs to be considered while selecting the employees of the company? Like who plays a major role? What will be the tenure of that employee? What would be the performance condition that needs to be kept in mind? So that alignment needs to be there. What is the company's goal and how we are aligning the employees' performance to that goal. Coming up to the pool size. So what is the pool size that promoter wants to dilute as a part of this plan, compensation plan? Then the vesting condition. Now vesting condition can be anything. It can be service based, it can be performance based, or it can be both. Then exercise price. Now exercise price for the ESOP scheme, what it has to be. So there is no statutory norm which has provided that what shall be the minimum exercise price or the maximum exercise price. But as per the Companies Act, if it is a equity settled plan, then the face value of that particular share shall be the minimum exercise price. But there is no maximum value. So it can be the FMV as on the date of the grant as well. Then coming up to the next aspect, which is lock-in period or the exit terms. So why this lock-in period and the exit terms? So whenever the employees exercise the shares, so now that shares, what is the right on that shares that the employee has? So clear restrictions needs to be defined. We have a SHA in place where we'll have a particular terms, right of first refusal, and then drag along, tag along rights. So all that rights needs to be aligned to the scheme so that employees are aware, though they are partner in the company, but still there are restrictions on them on the sale or to sell the shares of the company. Then comes the treatment on the exit. With respect to exit, there are various conditions which we can incorporate. What happens if there is a resignation, death, and retirement? So there are Companies Act rules also, which specifies in each of the stages what shall be done if it is equity settled plan. Moving forward, so, based on our past experience, when we have actually implemented different plans for the clients, these are the observations and considerations that we will keep in mind while always designing the scheme. So, first is this lack of cross-functional involvement. So, this comes up at the situation where now there are different teams in an organization. Promoter is the one who will decide what to allot, how to provide the benefits and all. And there is a HR team which will communicate it to the employees. Then there is a finance team which will take up accounts and taxation part. And there is a legal team who is actually preparing the scheme or reviewing the scheme. So all these functions needs to be aligned. They all should know what the scheme is about, whether it is aligned with the company's goal, and what is the type of the plan and all that. So they should be aware of the scheme and what needs to be done with respect to the scheme, so that each team should be aware of. The next consideration is complex of multiple performance metrics. So in the scheme, to make it more complicated, the scheme conditions should be very simple, and any performance conditions that needs to be bring in, they should be aligned with the goal. Like if you have a revenue based conditions, then it has to be aligned with the revenue of the company. Like the growth shall be aligned with the revenue of the company. Coming up to the next part, exclusion of key non-employees. So this is like if you have a ESOP plan in place or equity settled plan in place, what about the consultant or the advisors who are equally a part of the organization growth? For them, you can run a parallel scheme of phantom stock or SaaS and settle them in cash. So they will also be eligible for the same stake, like the value of the company, but in a cash settled form. Then unclear treatment on resignation, termination, death and incapacitation. So what happens is, as per the Companies Act rules, it specifically states that in case of death and incapacitation, what happens is whatever the unvested options are there, which are like yet to be vested, this all will get vested at the time of death or incapacitation. So that is the company's rule. So while drafting the scheme, we cannot go against the company's rule. We need to keep that in mind, and the same clauses we need to incorporate that in our scheme. But for resignation and termination, we can have our own clauses. Like if employee has resigned and he has joined the competitor, So in that case, we can clearly define the clause where in future if the employee resigns and he is joining some competitor, at that point of time a clause or condition can be put in that all that vested shares they can opt to cancel it. So it is on the discretion of the board that can be incorporated. Then the provisions for major events, like if any merger or acquisition is happening, then at that point of time, why not to include the employee and reward them as a part of this merger or acquisition? So in that case, in the scheme, we can include for accelerated vesting for that case. Then funding constraints at the time of exercise. So what happens is we will float, company will float a ESOP plan and they'll implement it. Post that when it times for the employee to exercise the shares, there comes a challenge where the employees will not be able to exercise due to their cash flow issues. At that point of time, what can be done? Since the scheme is already incorporated, now before only it was planned and clauses have been incorporated accordingly, like we can provide the option of cashless settlement, canceling the options and giving them the cash payout, or we can arrange for the loan assistance for them. Then accounting and tax implication. For accounting and tax implications, these are with respect to the finance team. What is the plan? If it is equity settle plan, what all are the accounting compliances? How will the expensing be done? How will the deductions be taken? If it is cash settled, what all are the compliances that needs to be done? Then the conditions for transfer, pledging, hypothecation. These are the main things where employee will not be aware of. He will think he has an option as an asset, and but he will not have a knowledge whether it can be transferred or not, whether he can hypothecate or not. In actual, they cannot transfer it and hypothecate it, but it's better to have that in the scheme as a condition or the clause that this cannot be transferred. However, there is an exception for the transfer that in case of death of the employee, it can get transferred to the legal hire, but in no other case it is transferable. Then we need to determine the liquidity events as well, as to what all are the liquidity events when when the employee can get the exit. Example, if there is a IPO or if there is a change in ownership control, or there can be any other event which the board defines. Now, designing is done and the scheme is implemented. Okay, once the scheme is released, now it got approved also. Now, post that, what is next? So, next is we need to communicate to the employees, the eligible employees whom we need to issue the grant letters and all. So, once the grant is done, it means the company has committed to reward the employee subject to the fulfillment of terms. So there are certain challenges like the date of grant. What shall be the date of grant? So the date of grant shall be date when the grants are actually approved by the approved by the team, or date when it is communicated. Actually, it is the date when it is communicated. So that will be the grant date. So all these dates, because why grant date is important? Because from that day my vesting will start, and based on that vesting, accounting, taxation, and all other things takes place there. The other part is the valuation. Now it states that we need to do the valuation at every grant. So is it like if I grant monthly also, then I need to do valuation like every month, or how is it? Now there is no norms or statutory norms for this, that within this period the valuation has to be done, or it is applicable only for this period. But to, like in the industry, what's the best practice is to have a quarterly or to have a half yearly valuation in place. And for that valuation, to have a quarterly or half yearly valuation in place, and in case in between, if there happens a certain event which are like very significant or change in ownership or something, in that case the valuation needs to be adopted at that point of time. Then grant exceeding the pool size. So this is like you have implemented the scheme long back, And it is not like you are granting at that point of time. You will be granting in phases. You will be granting in different years as well with respect to that scheme. So now what might happen is the company or the team will not be aware as to what was the pool size. So there requires to maintain a proper grant register, and there always needs to be updated what is the pool utilization, how much pool has been utilized. In case if the pool is totally utilized, we have an option to amend the scheme and increase the base size. But that can happen, that granting can happen post amendment of the scheme only. So that needs to be kept in mind. Then inconsistent communication or HR records. So this is like we should have a proper grant templates and employee dashboard. So this is like grant letters, agreements, they should be in the standard format. All the conditions in the grant letter are actually aligned with the scheme. So based on that, that alignment needs to happen so that if there are standardized grant letters and employee dashboards, it will be easier for the team to circulate it forward. Now, next is stage-wise vesting. So vesting is like during the time of vesting, what will happen? Employee will perform, employee will serve to the company. So all that conditions will start getting fulfilled. So once the conditions are fulfilled, the employee will actually get the right to exercise the options. So this vesting schedule is actually defined in the grant letters itself. And based on that grant letter, that vesting schedule will go on. Now coming to the challenges. Common vesting models used. So now here, as we said before, there can be service-based vesting, there can be performance-based vesting, and there can be hybrid models. So here we have actually given up the examples as to how it can take place. Now, if it is only service-based, we can say that the employee should stay over a period of like 3 years or 4 years, and whatever is the portion of pool, like if it is 10% of pool. So 10%, if there is a 1,000 ka pool, 1,000 ka 10% is 100. So 100 will get divided 25% each year equally. And this is how that service-based vesting will happen. If it is performance-based, then it can be linked to turnover targets or the EBITDA targets. And based on that, the allocation can be provided to the employees. Now, in case the employer wants both the time-based, like service-based, he should stay for this many years, and then he should perform also. So the performance conditions are also there. So in that case, we can also have a hybrid model in place. Then comes the milestone based vesting. This is majorly used where there are big projects for the company, and for each of the project, the key employee is working on that particular project. So at that time, we can actually use the milestone based vesting for the employees. Now we have said that it is used by startups, manufacturing listed R&D. But the thing is, there is no specific structure which is defined for each industry. It can be determined like based on the requirement of the specific industry. So it can be customized. Now at vesting stage, what are the challenges? So basically the main challenges with respect to vesting conditions or the timeline. So since the conditions needs to be clearly mentioned in the grant letter, because plan will cover the overall conditions but not employee specific condition. So it is the grant letter which will actually cover the employee specific conditions that needs to be fulfilled. Then there are different situations, like if employee leave midway, then what is the policy that needs to be done? Is partial vesting allowed, not allowed? This all actually can be incorporated in the scheme. Mostly it is schedule based. So if it is like for a year or the end of the year or the end of the period, if it's not there at the end of the period, then actually it is not partial vesting also. It will be like vesting for the entire year. Then treatment on this death and disability that we have already discussed as per the Companies Act. We have a specific conditions that needs to be in place. Poor communication of vesting schedules. So now this vesting schedules is like, though it is there in the grant letters, but how will company keep track of it? So it's better to use a dashboards or employee management tools where they can keep track of the performance and the conditions, whatever, if they are met or not, whether vesting has happened or not accordingly. Then treatment in case of voluntary resignation, same thing, if any conditions needs to be incorporated in the scheme and else. During the exercise stage, now we have come to the stage where actually employee, now this is a stage where actually rights will get converted to the payout. Now it means that ownership becomes real. Now the employee is eligible for exercise of options, which is like he will get in return the shares, or if it is cash settle scheme, or there is a cashless exercise option, then the cash payout will happen to the employees. So at this point of time, the main aspects will be what is the valuation and the taxation impact on the employees and the employer. Now, challenges based on exercise. So, clarity on the exercise period. Now, in the scheme, they provide the exercise period, but from which date it has to start. That needs to be kept in mind, whether it is from the date of grant or whether it is from the date of vesting. Employees unable to fund the exercise price. Now, this is the major question. Like, we will float the ESOP plan, but at the end, when employee will not only have that cash flow to pay up the exercise price, then actually there is a no point in floating that ESOP scheme. So for that, we should have the alternative plan in place where like we are providing the loan assistance to them, or we are doing the cashless exercise mechanism there. Then TDS deduction and the perquisite valuation. Since this ESOP or the compensation plan is a part of the salary only, so the withholding and the perquisite requirement will follow whatever is as per the section 192, which is like TDS for salary cutting. And then absence of communication on tax liability. So what happens at the start of the scheme implementation and when the grant letters are issued, it will be conveyed to them that you will be rewarded. But at the same time, employee should be aware that what would be the tax liability in his hands, because if there are ESOPs, there is no liquidity in hand. But at the other side, there will be a tax payout. Then how will he deal with that? So all that needs to be communicated. How to fund the cash settlement? So what happens is often entities will have cash flow issues while making the cash settlement or payouts. So there are different options that are available. Like giving them the staggered payments in installments in phased manner, we can provide them the payouts, or we can look for some short-term debt arrangements or funding or investment round. And there is another thing which is like fund houses set up for ESOP exits. This is similar to the PMS thing, which is like investors are investing in that PMS and they again investing in separate companies. So it will work in the same manner. Here also investor will invest in this fund, and this fund will use this money to like take up the vested options or to buy out that vested options from the employees. Now there is HISA platform, HISA fund, which has actually launched a 35 million fund specifically to provide liquidity to the employees. And again, by this, this will happen like two way. Once employee will get the exit, and the second part is investor will have a stake in these companies. Trigger point for settlements. So now there are different points of settlements. What if the company having a profits and company have adequate reserves? In that case, they can go up with a cash settlement scheme and can provide immediate liquidity to the employees. Second is the funding round or the investor round, where the new investor will come in and employee will get the exit. In that way, the dilution in the cap table will get removed. Then there is another thing where the employee will exercise and hold the shares, and there what will happen is he will have a ownership mindset till that new investor comes in and provide them the exit. Then the secondary sale and the exit. This is nothing but transfer of shares to the promoters, or if there is any merger or acquisition happening, or there is any IPO in place. Poll is coming. Request you to please respond to the poll. Now the next thing comes up is being DD ready. Now our ESOP is in place, and we have provided it to the employees, and all thing is happening. So the other side, whether we are being DD ready. So with respect to the compensation plans, there are certain compliances that we need to do. So four things that matters for being DD ready. This is due diligence ready. So to be like being due diligence ready, what are the factors that needs to be kept in mind? One is compliance, second is documentation, and third is accounting and the taxation part. So I just go to each of them and I'll briefly explain. Now compliance readiness. This means from when the ESOP scheme has been implemented. Okay, whether I've got the proper approvals or not, whether I've done the proper filings or not, minimum vesting period, whether the scheme that I've prepared is compliant to the Companies Act, SEBI rules, and SHA agreement. So all these factors needs to be kept in mind, because these are the ones now cap table and dilution impact. I have really, implemented a scheme, created a pool. If that is not reflecting in my financials, not reflecting in my cap table, then the investor that is coming up will not be aware of all this. So these all are the compliance points that needs to be kept in mind. This will actually give the investor the confidence to come into the company. Next is communication and documentation readiness. So with respect to the communication, whether orientation sessions has been happened, whether SOPs are in place with respect to employee FAQs, whoever are the new employees that are coming up, and we are providing them the allotment, we are providing them that compensation plan. In that case, whether that FAQ summary sheets are all prepared and have they been provided to the employees and being communicated properly. Then the documentations that all are, whether all that are in place or not, plans will be there. So after a point of time, there may come up a requirement to amend the plans and all that. So all that versions of the plan should be in place. All resolutions, approvals, valuation reports shall be in place, and the documentation set should be ready for that DD compliance part. Accounting and valuation. So here is the main part, like accounting. Accounting, there are two things. One is the valuation part. So briefly, the valuation, when it is required, there are two stages where we need to do the valuation. One is at the grant stage and second is at the exercise stage. So grant stage, it is like as per the company's law, we need to provide that. At the time of exercise, this is for the employees, where we need to do a merchant banker valuation for the purpose of income tax, to provide that perquisite value to the employees. Then comes the expense recognition. Now, for the equity settled plans, the expense will be recognized over the vesting period. Like there is a grant and then there is a vesting period. So over the vesting period, that expense will be recognized. In cash settled plans, the liability is actually recognized and remeasured every year. But in equity settled plans, the expense is recognized at the point of grant only, not on year basis. Then the provisioning that needs to be done in the financials, that needs to be in place, proper disclosures in the notes to accounts. Then with respect to taxation, so in the hands of the employees, it will be taxed as perquisite. So when it will be taxed, it comes at the time of exercise. So there is no taxation at the time of grant, at the time of vesting, but there will be a taxation at the time of exercise. Then company deduction claimed in line with the judicial precedents. Then there are FEMA and cross-border compliances. So this comes up in the case where either Indian entity is giving ESOP to non-residents employees, or overseas entities giving ESOPs to Indian residents. So in that case, that ODI and FDI requirements will come up, and that needs to be complied with. Then their ESOP management tools has to be in place. This will help in automating the entire system that will track from the grant stage to the vesting stage, and then what happens at the exercise stage and related reportings. So this is the accounting and the taxation impact that I actually have covered in the previous slide. Um, this is just the brief of that. Grant vest and exercise. So employer, this is in the hands of the employer, where employer will actually claim the deduction during the vesting stage, and then when the at the time of exercise, when the equity and the equity or the cash payments is allotted, the same thing will be accounted in the books. Then they will have that company will claim the deduction under income tax, and then withholding provision that needs to be done by the employer. Taxation for employees. So for ESOPs, taxation in the hands of employees as perquisites. So since the employee is receiving shares in his hand, so that will be taxed as the perquisite. So what will be taxed is FMV on the date of exercise minus the whatever was the exercise price that was set by the company. Then there will be a second stage taxation for the employees, that is capital gains. This will come up when the employee will sell the shares. Either the company will sell the shares or it will be like buyback by the company. In cash settled scheme, what happens is it will directly be a cash payout to employees or the consultants. So it will be taxed directly at the time of payout, which will be taxed as bonus in the hands of the employees and business income in the hands of the consultant. Okay, now there is a startup benefit also for the employees. Startup who are like eligible startup who have taken the registration under section 80 ISC. For them the benefit to the employee is they can actually postpone the taxation. Like in the previous slide, we have told at the time of exercise. At the time of exercise, it will be taxed as perquisite. But for the startup case, it has actually postponed. Postponed to either of these three stages, which is like 5 years from the end of the year in which they have actually exercised that options, or the date of sale of shares, or when employee actually resigns and cease to be the employee of that particular company. ESOP trust. So I just give a brief on the ESOP trust. Modes of issuance. So here in the trust route, what happens is company will actually create a trust. So in the trust, the company will give a loan. Through that loan, the trust will actually purchase the share from the company. And then post that in the next stage, whenever the exercise event happen, the employees will get the shares directly from the trust and not from the company. So trust is the mediator here through which that exercise thing happens. So this is the structure where how this operational process will work on, like funding, first funding the trust, and then trust will acquire the shares, and at the time of exercise trust will give the shares to employees, and then post that when there is a sale by employees, at that time trust will be the one who will actually take back the shares from the employees. So this is the process that will go on in case of trust. So I'll give a brief difference about the ESOP trust and the direct route. So in case of ESOP trust, the thing is, since the shares are actually already transferred to the trust, in that case company need not have to create a dilution further. So any investor that comes up, they don't have to dilute because the shares have already been allocated it to the trust. The only problem here is trust will be like having a double taxation. This is like at the time of exercise. At the time of exercise, when actually the trust is transferring shares to the employees, at that time there will be a capital gain impact implication in the hands of the trust. And on the other side, the employees will be paying tax on the perquisites. So that is the major difference and major con that we can say we have in case of trust route. So we have come up like we have completed the technical part of it. Now I will hand it over to Vijay Simha to take this forward.
Thank you, Divya. Thanks a lot. So now this comes to the end of the technical part of the session. Now, this is the service offering from Anveshan, which is called MyPace. And what PACE stands for is Performance and Achievement Compensation Engine. So we have been, speaking about compensations for the last, 1.5 hour. And this MyPace is that package that offers solutions for all entities in terms of making it easy for them to implement their compensation plans. And also it will there are wide range of services from ESOPs to SARs and phantoms. As Arun sir told in the beginning of this presentation, there is a assessment that you can take where you stand today, where this your entity stands today in with respect to these compensations in the resource tab under the on the Nation website. And post that, you can get in touch with us for any of your requirements. Now, going forward to the next part, we have the HISSA platform by Rule Zero, which is HISSA compensation, the smarter ESOP compensation modeling for companies. So they go with the criteria that HISSA compensation is a smart AI-powered tool to model ESOP and salary structures with proprietary data, clarity, and confidence. So this normally follows a four-step procedure. That's the organization chart builder, smart templates, model and simulation, and compare and adjust. So we have Durga and Reena with us who are going to talk more about what this platform actually does. I just request Durga to take over. Just a second.
So, hi Vijay. Can I take over or are
Yeah,
you still?
you can take over.
Right.
You're able to present your screen.
Yeah, just give me 1 second.
Vijay, just a quick check on the time.
Yeah. We'll be overshooting by another 10-15 minutes since he started a bit late.
Yeah. Hello everyone. Thank you first and for all for Anveshan for their in-depth information into ESOPs, the compensation plans, and what the compensation plan contains. So a little bit about HISA. So what we have with respect to ESOP is we currently have three main tools. One is our ESOP management portal, one on the admin side, one on the employee side, and the other one it's what we'll be showcasing today, which is the ESOP compensation modeling tool. Apart from that, we also have a portfolio manager and also a task manager, right? So let's go on with the compensation management tool, compensation modeling tool. So today we've heard a lot about what compensation is, cash compensation, ESOP compensation, and how what are the different steps, how to identify eligible personnel, pool creation, the designing of allocation framework and all. So to start off with the compensation tool, I've just opened it up and I think you can see the screen. So this compensation tool basically what it does is it allows you to model different allocation frameworks. So that's what we talked about, right? So the different parameters of the allocation, the weightages, and how we decide on who to give how much, right? So to start with that, we kind of first take into consideration the company itself. So we ask for a little context from the company that is asking for or that is choosing to build a model, a compensation model. So we start off with what type of industry they are. So for example, I select fintech, where they're located, Bangalore. right? So here we have two types of data import per se. So if they already have an employee list and they're ready to share it with us, they can upload their employee list, their salary structure, their hierarchy and such. Or if they want to remain a little anonymous and try out the platform or go ahead with like creating the organization structure from scratch, they can continue with the standard flow. So here we ask about the company's size. So all of these parameters we ask during onboarding basically lends to building the compensation structure, the allocation structure. So all of this goes into building our, feeding information into our HISA engine, and the engine crunches all of these onboarding data and then gives us basically the percentages or multipliers, these are multipliers. So here we ask the company's size, which is 1 to 50. I've chosen 1 to 50 employees, which is an early startup. The tech orientation. So this also lends into building, into kind of allocating more to, if it's a highly tech-enabled company, right? A tech-heavy company, then it'll lend itself to giving more multipliers or more options to engineering and software engineers and those tech-heavy personnel. So then we ask what stage your company is in. So right now I'll choose seed stage. And here we choose what kind of departments you're dealing with. So you can always add departments in the organization hierarchy. But then here we can choose what departments we need to add or what departments the company contains. For example, here it contains engineering and technology, product management, and sales and business development. So I'll go next here. So this is a sort of summary as what we've completed so far, what we've filled in onboarding. As you can see, we have our industry, which is fintech, the location Bangalore, our company size 1 to 50 people, and the departments that we've chosen, which is engineering, product, and sales. So I generate my org structure here. So what this does is it feeds the data that we filled in so far to OpenAI, and OpenAI then gives us or generates an organization structure, which we can then update or improve upon or make it fit the company that we're hoping to build for. Yeah, so this takes a minute. Right, so as it's taking up, yeah, so it's gone on. So as you can see, it's given us an organization framework or a organization hierarchy. We can see the engineering department here. We can see the product department here and the sales department here. If you remember that these are the three main departments that we have chosen. If we can go, if you want to edit it, we can edit the role title, the level, the department for who they're reporting to, and the salary structure as well. And if you can see here, this key role which comes in. So as Vijay had mentioned before during the presentation, that you would want to give a certain type of person or certain people more options than the rest of the company. So if you were to tag this as a key role, then we can this key role comes into play later on when we're designing the allocation framework, and then we can choose who to give more to and how much more to give. For example, between these three people, right, who are on the same level, although they're from different departments, we can give a key person a little more than another person who's on the same level. We'll come to that. So we go next on the compensation. So here we choose a template to build from. For example, here we have conservative compensation plan, a balanced compensation plan, and an aggressive compensation plan. So if you can see here, we see that the salary weight is 80% to 20% for a conservative plan, meaning more cash compensation is given. For an aggressive compensation plan, the equity weight is more than salary weight. So here, typically for startups who want to, give more in terms of ESOPs and a little lesser in terms of cash. So let's go with the conservative plan. So when you choose the template, you come into the compensation model builder. So here you see this hiring plan assumption, right? So basically you're not building for today, but you're building for the future. So not only you have to consider your current number of employees, but also your future hires. So for example, this is currently taking a 50% expansion. So basically we have close to 15 roles. So 15 hires. So it's taking 50%, which is about 7 new hires. So I'll just go back to the previous page. Right. And here, as we've heard in the presentation, right, the first step is pool creation, which is what you do here. So we've designated the company valuation as 1,000 crore. We've put ESOP pool as 20%. This is changeable. So let's take 15%, right? And then, so the pool value is shown right here, which is 150 crore. So we go next if we're happy with the pool, pool allocation. So right now it has already assigned multipliers using our HISA engine to all of the different roles which are in the company. So if you can see, the head of engineering has a 2.9 multiplier, the tech lead has a 2.3 multiplier, the head of product also has a 2.9. So as and when you go lower in level, right, you can see the multiplier sort of decreasing. So this means that people of a higher level, who are higher up the food chain, get a higher multiplier, and the people who are at the lower end of the hierarchy get like a smaller multiplier. And you can also see the difference in employees present already in your company right now and new employees. So you can kind of figure out if you want to change up the multipliers for new employees, and you can set that right here. And it'll also show you what the your P25, P50, P75, P90 numbers are, which are basically your percentiles, right? So do you want this employee to exist within the P25 to P50 percentile, or do you want to give them higher, closer to the P90 percentile? You can designate all of that right here. And at the end of this, you get how much is your total ESOP compensation and how much percentage of your pool are you utilizing for modeling this particular, compensation. So if you're happy with all of these numbers, I mean, it is a little arduous, I agree, but then this is important, right, to do, which is you have to allocate to each and every one separately, and you have to be happy with the allocation. So you go next if you're happy with this. Then you select your vesting schedule. So vesting schedule is important in the coming step, which is the P&L. And that also was mentioned in the in the presentation. So here right now I'm choosing a standard 25, 25, 25, 25, which is 25% of your grant every year, which is getting vested. So I go next, and here is basically what your accounting impact would be, which is how much you're basically spending as an ESOP expense year on year. So basically here you see your standard versus front loaded versus back loaded. So right, so you see the numbers here. Your standard is 12.36 crore on year. But then if you were to choose a front-loaded vesting schedule, which is, upfront give more number of options getting vested, and as you taper on through the 4 years, lesser and lesser options get vested, you see that you have to pay upfront a little bit more than the standard. And the same with backloaded. Backloaded is your, I mean, at the end of 4 years, you vest higher options. So you can kind of choose which kind of vesting schedule you want based on what kind of accounting you would want to do. So if you're happy with this as well, obviously if for this to be changed, you need to kind of go back and change how much your vesting schedule and such. So you complete the model. So when you complete the model, you kind of have one single model, right? Which you kind of you've built. Now, if you want to create another model, it's just as simple. You go into this, you go through the number of steps, because this is not only building one single model, but comparing between two different models. So right now I have a conservative model and I have a balanced model. So now I can compare between the two and kind of figure out what kind of allocation framework I want to choose, and what I'm happy with, because I would have to be happy with the amount each person is getting, how much is being accounted for, and what is my entire total ESOP budget at the end of the day, right? So I can compare between the models right here, where your option strategy is there. So I can compare between the two. So here you can see model A, how much is there, model B, how much is there, and what is the difference, right? So I can compare between the two and kind of figure out which one I like more, and what is, at the end of the day, what is my ESOP compensation look like. So yeah, so that is the main heart of the portal where you build your compensation strategy, you compare between different strategies, and you figure out at the end of the model, like, which strategy you would want to go with. So this connects as a pipeline to our ESOP management portal, where you can use the strategy to further grant options to employees. I've not talked about hiring plan yet. So hiring plan, as we saw, is 50% flat, right? You can also kind of customize this hiring plan in order to kind of figure out if you have a product, or if you have a roadmap that you want to feed into this to build your hiring plan. Yeah, I think that's the main part of it. I'll hand over to Reena for a little further.
Yeah. Thank you, everyone. If you want to get in touch, we will just leave a contact number there in the chat, and would like to take the conversation further. That's it. Over to you, Vijay.
Thank you, Durga. Thanks, Reena. Very well explained. I think we just had a look at the platform and it mostly solves all the problems. Whatever we just told in the PPT for the last 1.5 hours, I think we got a better view because it was done much, live. So, on completing that, I would like to take few questions that are there. I have allowed mic to all the attendees. So if anybody wants to unmute and ask any questions, we'll just take a minute. If not, you can reach out to us. We will be providing our, contacts for your reference.
So, Sima, we'll wait for a couple of minutes and then we'll end the session.
Yes, yes.
And
So, yeah, yes, sir, you were saying something.
yeah, request you to provide us feedback so that it will be helpful for us to know how we have performed today and then how we can improve ourselves in the coming webinars. And also, we'll be sharing HISA platform connection, contact details of Reena and Durga. We'll be sending out a mail on that aspect. You are free to reach out to them for their services.